All right, today we're talking about Texas Instruments. And wow, their latest earnings report, it was a textbook case of whiplash for investors. We're talking a classic beat and a drop. So let's get right into what happened.
So if you just looked at the headlines, everything seemed great. I mean, the company brought in $4.74 billion in revenue. That's a solid beat against what Wall Street was expecting. And, that's a 14% jump from last year and up 7% from just last quarter. So by all accounts, a really strong number, right?
But here's where it gets crazy. The market? It told a completely different story. As soon as those results hit the wire and after hours trading, bam, the stock plunged nearly 8%. So you've got this great revenue number on one side and this brutal sell-off on the other. Makes no sense at first glance.
And that's the big question we're digging into today. If the quarter looks so good, what in the world spooked investors? The answer, and this is key, isn't about what just happened. It's all about what's coming next.
Okay, so let's get into this disconnect. We're talking a strong quarter versus a really weak outlook. It turns out the market wasn't treating on the quarter that just ended, but on the one that's about to start. That's the whole story right there.
All right, let's look closer at the numbers because there's some nuance here. The revenue beat, yeah, it's plain as day, $4.74 billion versus the $4.65 billion everyone expected. But then you look at the earnings per share, the EPS. It actually came in a penny short of what analysts wanted. So what happened? Well, TI took about a 10-cent hit per share, mostly from charges for shutting down some of their older factories. So you've got a great top line, but a kind of messy bottom line.
And this slide really just says it all, doesn't it? On one side, you have the strong Q3, the good old days, basically. But on the other, you have the Q4 outlook. And that's the storm cloud that just rolled in and completely overshadowed all that good news.
Okay, so here's the real problem. It's all in the guidance for the next quarter. Management is forecasting revenue somewhere between $4.22 and $4.58 billion. The middle of that range, it's way below Wall Street's target of about $4.51 billion. And the EPS forecast, that was a big miss too. This right here is the smoking gun. This is why the stock got hammered.
But, it wasn't just the weak numbers that got investors worried. It was the whole vibe, the cautious tone from management on the earnings call. It really gave everyone a peek behind the curtain at the challenges they're seeing.
And really, the CEO, Haviv Ilan, he kind of set the whole mood with this one sentence. Everyone was hoping for this sharp, V-shaped recovery in the chip market. Instead, he used words like slower and moderate. And let me tell you, on Wall Street, that kind of language is a big deal. It signals that the big comeback everyone was betting on just doesn't have the juice they thought it would.
So this whole cautious vibe really boiled down to three things. First, that slow recovery pace we just talked about. Second, there's still a lot of uncertainty around tariffs and trade. But the third one is really, really important. TI is purposefully not running its factories at full speed. They're trying to avoid building up a mountain of unsold chips, which is smart. But running a factory at half speed is way less efficient, and that directly hurts your profit margins in the short term. That's another huge red flag for investors.
So with all this talk of short-term pain, you have to ask, what's the long-term plan here? This is where we get into TI's big strategic pivot. They're basically playing the long game, trading some pain now for what they believe will be a much bigger payoff down the road.
See, the company is in the middle of this massive, multi-year overhaul of how they make chips. They're shutting down their last couple of old, inefficient factories, the 15mm ones. That's where those restructuring charges came from. And at the exact same time, they are pouring billions of dollars into building brand new, state-of-the-art 300mm manufacturing plants right here in the US. It's a huge investment that hurts profits now, but the idea is that it will give them a massive cost advantage for decades.
And to really hammer this point home, management basically told Wall Street, hey, we've got a new North Star metric. For years, it was all about gross margins. Now they're saying, judge us on our long-term free cash flow per share. That's their way of signaling, loud and clear, that they are playing the long game. They're focused on generating real cash over the long haul, not just hitting some specific profit margin number while they're in the middle of this huge building phase.
Okay, so we've looked at the good, the bad, and the long-term plan. Let's put it all together. What's our call on Texas Instruments from here? This is the next call, our outlook for what's coming next.
First things first, let's remember where the strength in Q3 actually came from. There were a couple of huge bright spots. Enterprise systems and communications were up 35% and 45% from last year. And what's driving that? It's pretty much all coming from the explosive demand from data centers. That's a really important long-term positive to keep an eye on, even while the rest of the market is kind of sluggish.
Okay, so here's our final call. For the fourth quarter, we think they'll probably land near the low end of their own guidance. Management just sounded way too cautious to expect anything else. As for the stock price, we see it being pretty much stuck in a range for a while. It's caught in this tug-of-war between the weak recovery now and that really compelling long-term manufacturing story. So putting it all together, our rating is market perform. Look, the company is doing the right things for the future, but those short-term problems are just too big to ignore right now.
And a reminder, this is not financial advice.